This is a darn confusing stock in today's video, but I'm telling you, if you get it right, there's some really good opportunities here. So, what stock am I talking about? Gift cards. This company does gift cards. Very different from a lot of the other stocks that I cover, right? We're not talking about artificial intelligence or batteries or electric vehicles. I'm happy to cover a stock that's a little bit different and making gift cards. So, what company am I talking about? GiveX. Now, this company is traded on the main TSX board and on the OTCQX. GiveX's investors relation page says that it has a 20-year history of growth, a significant footprint of global brands, and a strong recurring revenue stream and balance sheet. So, I mean, what's not to like here, Cameron? What's so darn confusing about this company, this stock that you're talking about? Well, because I don't know much about the gift card industry, I started looking into it, and it's actually pretty good, right? Compounded annual growth rate of gift cards is somewhere between 17% to 12% CAGR, right? Depends where you are. But essentially, what I could find is that the gift card market is expected to witness significant growth in the coming years. And that really surprised me. I thought about it. I'm like, I don't use gift cards. And then I really thought about it. I'm like, yeah, I do actually all the time. Sometimes I don't even realize it. I'm just buying something online and then emailing it out. But I use gift cards fairly frequently when I really look at it. And this is what they're saying, that there's a growing demand for gift cards for online shopping and an increased use of gift cards as rewards, incentives, and consumer preference for experiences over tangible gifts. So yeah, when I read this, I was pretty excited, but then I wasn't. Why? Oh, because of the GiveX share price chart here, right? So here's their 3-year share price chart, and it went down substantially after 2021, like a lot of stocks did, but then it kept going down and down and down and down. Here's their 1-year chart, still down quite a bit, right? Year to date chart down, 1 month chart down, right? Up until you get to about the 1 week chart. That's the only time period in the past 3 years where they have not been going down in share price and losing shareholders money. So that's concerning. So, what are we looking at here? Are we looking at a company in a growing gift card industry that has a lot of opportunity? Are we looking at a failed stock, which doesn't make a lot of sense? We need to go figure this out. If GiveX is in a growing industry and they're a growing company with a good balance sheet and increasing recurring revenue, like they say on their investors relations page, how come they're going down instead of up? Okay, let's start with the basics, right? GiveX right here, they talk about connecting powerful transactions, which starts to lean into the fact that they're doing more than just gift cards, right? They've got all kinds of services they provide, including engagement, gift card, loyalty cards, integration with apps and point of sale, POS machines, analytics, and payment options. So they're a bit more than just gift cards. 376 employees, 12 global offices, strong cash balance. They keep saying things that I like hearing in 2023. Who do we do it for? I mean, the list of merchants here, right? And this is what I like investing in some of these longer term stocks, that simply their clients are just absolutely amazing. How they make money, service and payment revenue, monthly recurring service fees, regular reoccurring fees, card production revenue, transaction. I mean, my gosh, this looks good, right? This is a successful business plan, or we've seen it be successful with a whole bunch of other companies, I should say. Everything is up except for one thing, and we need to talk about it. So their revenue is up. Their annual recurring revenue is up substantially. Gross transactional value up. Merchant locations up. POS gross transactional value up. Merchant locations up. The one thing that's really down, adjusted EBITDA. 2021, it went down from 9 million to 8.3, and in 2022 it went to 6.6. Now, so far in 2023, their adjusted EBITDA is up from 2022. So last year they had 2.3 million at this point of the year, and this year they have 2.7 million. So they're saying they're going to get more than 6.6 million adjusted EBITDA. How much more? I don't know. But essentially, this company has been on the decline in adjusted EBITDA only for the past couple years, and it looks like they might be recovering a little bit. Second quarter highlights: 16% growth of revenue, 18% growth of gross profit, 18% growth of adjusted EBITDA. Net loss decreased 66%, 21% growth in their total transactional value, and 51% in POS gross transactional value. Payroll costs are the key focus to improved EBITDA and positive net earnings. Employee compensation as a percentage of gross profit was 53% and 54%, respectively. The company believes that its ability to reduce employee compensation as a percentage of gross profit is an indicator of its success in managing costs and profitability. This, if you're looking to research the company, seems to be the major thing holding it back is their gross profit versus employee compensation. But when I see it as one of the two operational highlights, they obviously know about it. They're trying to communicate to shareholders about it. I don't mind that, right? ARR, which is both recurring and reoccurring revenue for the trailing 12 months, increased 11.8 million from 59.3 to 71.1, a growth of 20%. 20% growth in recurring revenue. I mean, people dream about recurring revenue. This company is growing at 20% a year. That's fantastic. 126 million shares outstanding with a float of only 65 million, as there's 44% insider ownership. Some people like insider ownership, some people don't. Just thought I'd point it out. Red flags. What are my red flags? Why would I not invest in this company? And then green flags. Why I would invest in this company. And before I do this and give my opinion, don't forget, I'm not a financial advisor. I'm definitely not your financial advisor. Nothing on this video is financial advice. I am one average retail investor who likes talking about stocks because good communication about stocks makes us all better investors. Not financial advice. Thank you. Red flags are share dilution, employee compensation, and I've never heard of this company before, right? Honestly, this is just my initial video. I just started researching them. Everything I like, though, pretty much, right? At least I like more than that declining share price. Just keeps going down, 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 down. I need to go figure out why. Just on the year, down from 66 cents to 40 cents as I record this today. Price to sales is 0.64. People are factoring in absolutely no growth, even though this company, according to their own earnings and MD&A financial statements, are saying, 16, 18, and 20% growth on the year. Interesting. Cash flow trends, because yes, they generate pretty good cash from operating activities, has been going to paying down a bit of debt. Now, overall revenue, I guess one of the concerns for 2022 was you did notice that expenses, which are the yellow and red bar there, were higher than the green bar. So they've struggled in 2022 to be profitable, which they weren't, right? Can they correct that in 2023? Can that turn the share price around? Maybe not right now. The technicals are saying this is a hold to a sell. It hasn't been pretty recently, and I don't know if it's going to stop anytime soon, the way the macroeconomics and the bear market in microcaps has been going. So the question becomes, what price, if you're interested in this company or stock, what price can you buy it at? The green flags, why I'd want to invest in this company right now, well, probably not right now. I've already admitted it. I need to go figure some things out. They're in a growing industry. This is a growing company, right? That's the two things that could send this share price up, right? They also have pretty good communication. They've got their own YouTube channel. You can see they've got some videos from 4 months ago, 2 months ago. So, I mean, there's some communication, even though I haven't gone and watched all of this. I like communication from a stock. And again, I'm going to be a broken record here. I need to go do more research. You go do more research. Let me know what you think. But hey, this is 2 stocks in a row. I'm putting GiveX on my watch list, and I'm going to continue researching them, honestly, because as the share price keeps going down, and when I see those healthy growth numbers and the fact that they're turning around their EBITDA and they might be profitable in 2023, there's a lot of things that I'm starting to like as shareholders tend to bail out and sell. So, is this one of these opportunities because share price has gone down? Maybe. I don't know for sure, but I'm going to keep watching. GiveX is going on my watch list. Thank you for recommending this stock to me. My name is Cameron. You've been watching Common Sense Investing. Thank you for your time.